Arr, me hearties. I wants to sell you some life insurance, I do, matey.
Hi, this is James Burns. I'm trained as an attorney and I do life insurance. And I'm here with Rob Lambert and his asset protection training. Why did we design this for you? Well, so that you're coming up against a pirate who may be trying to sell you inappropriate or unsuitable life insurance. The reason I got involved in it was I was doing estate planning, and for years I would encounter folks that were selling insurance to my clients and they didn't know what they were doing. They had several years in the industry and still didn't know what they were doing. Now, the industry makes them do continuing education, but for some reason, some of these guys just seem to worm through. And it's always shocking to me when I encounter one of them that's been doing for 20 years and they still don't know fundamental concepts. So as a result of that, I decided I should be out there doing it and kind of put the legal practice aside and just want to help folks understand life insurance, keep them away from the pirates. I feel like the colonial marauder out there trying to chase down the pirates basically and help folks get the suitable products that they need. Now, we think of life insurance. There's really three fundamental questions that come to mind. And it's what type do I need, and how much? Those are really questions. And most of this is done with a financial needs analysis where a insurance professional is going to come to you. They're going to take notes about your specific situation, and from there, they're going to design a product and or class of products that fit your situation. Next, you need to know that we have it for two main purposes. One is you as a person. Two, your business. Life insurance works as a continuation plan in case the CEO or a key person in a company was to go down. Either they become disabled or they pass away. We often need life insurance in there as a resource for cash. And we'll talk about how you build up cash values inside that policy just beyond that death benefit. So in other words, there's a way to use it for payment to yourself rather than just you dying. There really is such a thing as life insurance, and that means you're able to use it while you're still alive. It's not just something that you're going to pass down to your loved ones and you have to become an angel for them to get it and for it to become useful. Well, historical aspects of insurance, it's been around for centuries. And to 5000 BC, many of the merchants traveling the Silk Road to China would insure their trip. We find life insurance seems to have evolved around the Roman Empire, and they had a thing called the Burial Club, which would cover the costs of funeral processions and memorial services, as well as the plots for burial. In modern times, which means currently today, we have a product that's very similar to that called Final Expense. It's small policies, and a group of individuals called the National Association of Funeral Directors have determined with statistics that the cost of burial and memorial services is somewhere between $10,000 and $30,000, depending on what locality of the country you live in. But for most people, they should have at least that small policy of $30,000. Now, going back to that need analysis, we need to understand the different types of life insurance product that's out there so we'll know what is the appropriate fit for us. First, we start with the one that a lot of people are familiar with, and it's called term. Term life insurance is temporary, and it means that you're buying it for a term. And most of those products will go for 10 years, 20 years, 30 years. Now, if you had a mortgage, and most mortgages are 30 years long, and you wanted to provide some life insurance protection for that mortgage duration, which one would you get? That's right, I can hear you out there. You would want that 30 years. However, sometimes the cost of a 30-year term policy could be such that it doesn't fit your budget. So the question is, can I afford it? Can I add it monthly so that I can afford this product? Next, we have permanent life insurance, and there's a couple of different varieties in the permanent life insurance. First is whole life. Now, whole life can be a little bit more expensive than term. In fact, it's probably 5 to 10 times more expensive. Why? Because you're buying it for the duration of your life. And that means you're going to be going beyond that 10, 20, or 30 years, possibly. Hopefully, you're going to be living a long life. And you're locking in a price today for the duration of your lifetime. as well as you're going to build up what's called cash values. It's like a little account that's attached to your life insurance policy. If we were to look at it like this, here you have your life insurance, and here you have this account that will build up cash values. What's the significance of these cash value accounts? Well, you're able to access that cash tax-free to yourself. It will build up tax-deferred, and you can tap those funds tax-free under a loan provision that's in the policy. As you well know, anytime you take out a loan, access to those proceeds are tax-free. The costs inside that whole life policy, again, may be very expensive. You're not sure what the life insurance company is going to be investing in, so that becomes problematic. The next vein of the permanent life insurance is universal life. And universal life also is referred to as flexible life, and it seems to have come around in the 1980s. And what those products allow you to do is be a little bit more flexible in terms of your monthly payments. In other words, if I was paying $300 a month, I could decide around the next month that I only have $200 in flexible payments, as well as the death benefit. The amount that's paid out to your loved ones could remain level. It could remain increasing, where it keeps going up based on the amount of payments that I feel like I. Next, we find variable universal life. Same thing as universal life, only the investment aspect of this is going to be tied to the market, which means we're going to be invested in the stock market and we're going to be invested in the mutual funds. The good side of that is you can get some of that high upside gains of the market when it's happening, which we haven't seen in decades now. And the bad side of that is that when the market's down, so are those cash values, which mean they might not be there to cover payments on your policy. So most people find out in the long term that a variable universal life policy doesn't do them justice. Finally, the one that's become very, very sought after right now is the equitable life. And it's because of the investment strategy. In the world of investing and financing, there's really three different types of investment strategies, just to keep it simple. There's fixed, and that's like when you go and get a CD and you know what your rate is. You're going to get your 1.1% out there. Then market affixed or market affixed type of strategy, where you're going to be subject to whatever the stock market is doing, or the mutual funds. Sometimes that's going to be up, most time that's going to be down, and you're going to be taking the roller coaster ride according to your tolerance. And then the third type of investing strategy is with an index. And let me explain how the index works relative to the universal life product. With the index, you're going to capture whatever the S&P 500 does. And as you know, indexes, we have the S&P 500, the Dow Jones Industrial Average, and the NASDAQ, as well as many other on a global level. But these are really the three biggest ones that we hear about in American press. So these products are designed to go along with the S&P 500, which is 500 of the largest companies in every kind of sector, so you're fully diversified. In fact, index investing becomes one of the best plays that we can ever make in terms of getting involved in the market. Now, with these types of policies, you're going to lock in your gains as the market's moving up. When the market goes down, you're staying right here. You're locking in your gains. You're never going down. So it has downside risk avoidance. Here's what happens, folks, for most people that are trying to go a long distance for investment purposes, is they ride that roller coaster ride, and then that day when they that age for retirement, they may be down here, which means on the bottom side of that roller coaster ride. Think about this for a moment. Say you're on 9/11, or perhaps 9/12, the day after, and the market was down over 50%. How much of your funds would you have to be able to access? Well, it would be dependent on how much you put away for years, but just knowing that you would be at least cut in half by one geopolitical event would be devastating. With this type of product, you're locking in your gain. And I want to stress that on how important it is, because the stock market is an unreliable indicator. It's kind of like gambling in most aspects. So imagine now locking in the gains, and when it begins to up again, you're starting from where you left off. So there is an old adage: when does a negative 30 plus 4 equals 0. And that's any time that the market goes down 30%, you have to get back to at least 43% just to get back where you started. So imagine doing that several periods of time during a 30 to 35-year period, which is the typical duration for retirement. So what I'm telling you right now is an insurance product could be a savings type of investment for you. Not only will it provide that death benefit for your loved ones, but it is a way to save up tax deferred and then access those funds tax-free retirement years. Now imagine doing that every year in your retirement being completely tax-free. Do you think that the way into this deficit and the way we're going to fund the Healthcare Reform Act, that taxes aren't going to go up? If you do, I wish it was true, but facts are, folks, that taxes are going to go up, and you are going to need a tax-free strategy in retirement. You know this. The typical IRA and the 401k is taxed at ordinary income at the point of retirement. So whatever year you decide to retire, 65 typically, you start getting taxed at whatever tax bracket you're in at that particular point. And sometimes that can be quite devastating, especially if you were planning to retire in a lower tax bracket. It's almost inevitable that you will be retiring, in a higher tax bracket. So again, you want to look at a tax-free strategy. So life insurance has this aspect of covering risk, taking care of our loved ones, and replacing income if we're ever gone. And while we're still alive, we can access this cash values, this tax advantage savings account, tax-free, and utilize that income in our retirement years. So in subsequent installments, I'm going to take you through a journey of understanding at least 100 different strategies for both personal and business. And sometimes when you're just a foreign individual residing here in the United States, there are instances in both your estate plan and your business where you also need to think about plugging in life insurance to just cover costs that could be devastating to you, your family, or your loved ones.